Welcome. Hi, everybody. Thanks for coming today. This is the second topic in our startup webinar series. Uh, this one's on Series Seed financing term sheets, part one, and this is on economic terms. Previously, we did a presentation on key terms in your entity documents, and so now we're moving on to the financing term sheets. Like I said, this one's on economic terms. We'll do another presentation on control terms, and then a third on just the other terms that are involved in a Series Seed term sheet or a Series A term sheet, kind of using those a little bit interchangeably here. And then we have a cap tables basics and a convertible note financing presentation coming up. So stay tuned for updates on when we're going to be doing those. A couple reminders on this webinar. It's going to be recorded, so you'll have a chance to revisit the material and get a send a link or at least of the slides and the materials that or the recording here, so you'll be able to look at that again. And then also, this is meant to be interactive if possible. So if you're on and you have a question, please submit something. Submit your question through the Q&A, and I'll be taking a look at that from time to time, and we'll answer your questions as we go. So if you have a question about a certain slide that we're dealing with, go ahead and jump right in and ask the question. All right. So first, quick slide on us, Deutsche Legal, where our core focus is really helping entrepreneurs solve complex business problems. And so, oftentimes that comes in the form of a startup company looking to raise money. And so that's what we're talking about today, talking about, getting financing for a startup company. This is me. I've been practicing for over 15 years now. My practice really focuses on private securities offerings, so startup financings like we're working on today or talking about today, M&A deals, and then general corporate work. So that's me. I won't spend too much time there. And then quick disclaimer, like any lawyer might have here, this is a presentation intended to be just for general information purposes. Anytime you're doing any sort of legal work or have any sort of legal issue, it's going to be very fact specific, and so your situation could be different than what we're talking about today. So always consult a lawyer on your legal questions. And again, this is just meant to be for general information purposes. All right, let's get into the substance here. All right, so when we're talking about Series Seed financings here or Series A financing, we're talking about a startup company looking to raise money to execute their business plan. And so this first slide talks about, well, who are the players involved in this type of financing. And the most important person involved in the whole transaction is the entrepreneur, right? So if without the entrepreneur, then there's usually not a business or a company to invest in. So that's going to be the first player involved. And while we're on the topic of entrepreneurs, oftentimes we have clients that call and ask, should I get financing? And my general statement to that is, or response is, that you want to bootstrap if possible. As long as you can, I would suggest bootstrapping. But there's lots of companies that are not set up for that. So there could be either situations where the entrepreneur or the founders need to get a paycheck, and so it's hard in the beginning if you're pre-revenue to pay yourself, and so you may need to raise money for that. But more typically, it's something that's a type of company that needs to raise money. So it could be no operating history pre-revenue, and you're focused on acquisition of customers, for example. That could be the type of business that you're running. And so you're going to be operating at this, just investing money into the company and not taking any out. And so if you don't have that big bank account to invest in yourself, then or to invest the money yourself, then you're going to have to get outside investors. Could be a high growth company. Could be chasing just a large market, with a potential to grow with big returns. But again, there's no clear path to profitability right now, and you're just need to pump money in to make hires, do development, whatever you're doing. You need money to operate the business, and so many times that's a reason why you would have to raise money. And so that's the first, entrepreneur. And then the next set of people that are involved are investors, and those can come in a lot of different forms. There's angel investors, and there's venture capitalists. There's friends and family. Friends and family is pretty obvious. It's just your friends and family who are willing to take a flyer on you and want to put money into your company. Angel investors or the big difference between angel investors and venture capitalists is that angel investors are investing their own money typically. So they have their own money that they're investing into the company, whereas venture capitalists raise funds from other people. So they have limited partners that invest money, and then they use that money to invest in certain companies. So they're kind of the curator of the investment. So they take a bunch of money in, and then they go out and they find places to put that money to work by making investments. Angels and VCs, both you want to find the angels and VCs that invest in early stage company. Venture capitalists, by just the nature of the term venture capitalist, usually invests in some sort of early stage companies. Angel investors can vary. There's angel investors that focus on real estate. There's angel investors that focus on startup companies. Angel investors that focus on later stage companies as well. So those are obviously the investors are a big piece of any financing. Then we have this term syndicate. You may have heard that term before. Usually that just describes a group of investors. So it could be an angel syndicate, which is just a group of investors that have gotten together to pool their money and invest in certain startups, for example. And so you may hear that term as well. Then you have lawyers. Lawyers are going to be the ones, either representing the investors or the company who are putting together the documents involved in the financing. A lot of those are, the financing documents include the term sheet, which is kind of what we're going through today. But once the term sheet is signed, then you have the actual documents that you're putting together that are referenced in the term sheet. And then lastly, oftentimes you have mentors and advisors who are involved with companies. And, I put that on here, even though they're not really typically investing cash, although sometimes they do. But I hear, people use these terms. Sometimes they're used interchangeably. I like to think of mentors as more as the industry veterans who provide advice, and they're not asking for anything in return. So somebody you can just call and ask a question, get advice or get an introduction or something like that, and they're not asking for anything in return. Whereas, typically I hear the term advisors, or I use the term advisor for those that are looking to get paid, either some sort of hourly rate or retainer, or they're advising entrepreneurs for equity. And so, I'll note that that's one of the biggest issues I've seen with startup companies sometimes that have issued equity to advisors or people who have said they're going to be advisors without vesting or other provisions in there, and then really haven't received much in return from those advisors. And so, I always suggest to be careful with advisors who are asking for either equity compensation or other compensation from a startup company right in the beginning. I would guess it would be, if you're going to issue equity to advisors, I would make it sure it's a very small percentage, and make sure that it is subject to vesting with, a reasonable ability to claw that back if they aren't really performing or providing much advice. All right, so that's the players involved. Let's talk about valuation. So, this is another thing that comes up often. I'll have entrepreneurs who call us and ask, well, what would be the valuation of our company? And, for a startup company that's pre-revenue, it's really hard to say. It's not really an exact science. Because you're pre-revenue, so a lot of the things that can happen with evaluations, like a discounted cash flow model or something like that, doesn't really apply. And so what I have noticed is that most investors looking at startup companies, or that are comfortable investing in startup companies, they aren't looking for some sort of formula model, because really the financials that you have at this point are projections, and the projections everybody knows are ultimately going to be wrong in some way. And so I find that investors are really looking at what is the experience of the team, who's involved. Are they a third-time founder who's had successful exits? That's going to probably lead to a higher valuation than a first-time founder. What's the stage of the company? Have you made progress? Have you hit any milestones? Have you developed an MVP? Things like that. That's helpful to determine what valuation the company's going to get. competition with other funding sources. That's another one. So if you have, it's a hot deal and there's a bunch of other VCs or angels that are looking to invest, then, that can drive up the price. It's more of an auction style fundraising situation at that point. Then, size of the market and then numbers. So size of the market really goes to if this company can execute on its business plan. What size is the market? How big can this company be? If you're a restaurant, just a single location restaurant, for example, the upside is pretty determinable. You can fill that restaurant and do several turns of the tables each night, but there's not really much more than that, right? Whereas if it's a company like Facebook or something like that, where there's the market could be huge, as far as users can be, millions and millions of people, then, and you can potentially get advertising or whatever, and there's a huge market for that, then that's obviously a larger market, potential larger upside, and so that can affect your valuation as well. All right. But again, just last point on this, it's really not, it's more of an art than a science. With startup companies that are pre-revenue, I don't often see, financials pulled out or projections really even looked at too much, other than to determine what might be the size of this market. Okay. All right. So let's talk about, in this term sheet, what might be in there. You have these price provisions. And so the biggest thing with price provision I see, obviously you have, what is the price per share that we're coming up with, but really that's backed into by this pre-money versus post-money valuation. And so we back into a price per share based on what this valuation that the investor is willing to invest at. So, pre-money, you probably heard these terms, pre-money and post-money. And so pre-money is really just the valuation of the company without the investment. So before the investment goes in, what is the valuation? And then post-money is just that pre-money valuation plus the amount of the investment. So if a company had a $4 million pre-money valuation and an investor was going to invest $1 million, it would have a $4 million pre-money and a $5 million post-money, because that's the amount of the investment. And so entrepreneurs can get tripped up on this from time to time. So you may have an investor that says, I'll invest $1 million in your company at a $5 million valuation. And so if you hear that, what percentage of the company would that investor get? And the answer is, it depends. If it's post-money, if that investor was talking about a post-money valuation, then the investor would get 20% of the company. That is, investing $1 million in a post-money valuation of $5 million. So over 5 is 20%. If it's a pre-money valuation, then the investor gets 1/6 of the company by making that investment, or about 16 2/3%. So there's a decent difference there, right, between that 16% and 20% on what the investor gets. So pre-money, and really it's just a difference between that term pre-money and post-money. So the key here is just to be clear when you're talking to potential investors, to know, are they talking pre-money valuation or post-money valuation when they mention how much they're going to invest or may invest. All right, fully diluted. This is another thing where you can get tripped up. So fully diluted just means that we're going to calculate the price per share, that all options, whether they're issued or unissued in the equity pool, will be counted as outstanding when determining that price per share. So if it is fully diluted, then we're going to take all those anything in the option pool, and we're going to consider that as issued when determining how many, or when determining the current shares, and then how many shares would be issued to the investor. So important to understand that term as well. Employee pool, we do have a separate slide on employee on the next slide, so we'll talk more about that on what that looks like, so, and how that can affect this. So anyway, when you're talking about price, you really want to be clear on whether it's pre-money or post-money, what the fully diluted amount, and then again, this employee pool, what's going to be required there. All right, so employee option pool. Oftentimes investors are going to come in and say, we want you to have a 10% pool when we invest. And so that just means that, and it's going to ask whether it's pre or post financing. And it's better for the investor for this to be the pre-money valuation, right? So the pre-money valuation includes that pool. is as if those were issued in outstanding shares. And so, again, this gets negotiated in the term sheet. And so they may say most investors are going to look for at least a 10% maybe unissued pool as part of the pre-money valuation that you would have to implement prior to them making the investment. And so, there's a lot of, I would say 10% is very typical, but the facts and circumstances is what should really affect what size of the pool you agree to in a term sheet. So, for example, if you don't think you don't need that many hires, and you don't need that size of a full 10% to make the hires and to execute on the business plan that you've proposed, then I would go to the investor with a budget and say, hey, here's who we need to hire, and then as part of this financing, and this is how many shares we would issue as part of the equity pool to these hires. And as you can see, it's a 10% is not needed. So if you can kind of go through that, that's helpful. And so that's why I say founders should have a budget on their option pool, so they can have a negotiating position when they come in and investors say you need to have X, Y, or Z as part of your option pool pre-financing. So yeah, that's really the biggest issue there, I would say, is the employee option with the employee option pool is it pre or post financing, and what is its size? All right. Big one here is liquidation preference. So, oftentimes when investors come in, they're going to want some type of preferred stock. And the preferred stock, what makes it preferred is typically that it has some actual voting provisions, which we'll discuss in our next presentation on control terms, but it also has some economic benefits with this liquidation preference. Liquidation preferences are often just downside protections for the investors in the downside scenario. But we'll go through here. There's really three alternatives. So alternative one is non-participating preferred stock. Alternative two is fully participating preferred stock, and then alternative three, which I don't see very often, or really I can't remember even ever doing a deal where we did a preferred stock with a cap, but that's the other alternative three there. So let's talk about one. So non-participating preferred. So this would have a provision in a term sheet that would say something like, first pay one time. I mean, one-time liquidation preference is pretty typical nowadays. If it's a company in trouble and really needs the financing and doesn't have much negotiating leverage, it might be a 1.5 or 2 times liquidation preference. But really, that's just saying how much will that investor get paid back before money can be distributed out to the common shareholders. And so it may say something for non-participating preferred, it would say first pay 1 times the original purchase price plus accrued dividends on each share of this Series A preferred shares or Series C preferred. And then the balance of the proceeds will be distributed pro rata to the holders of the common. And so you may think, oh, well, why would anybody, that doesn't sound like that great of a deal for the investor. They only get their money back, and then the rest goes to the common stock. But that's not really how it works, because all these preferred shares are convertible to common stock at any time. So what would happen is, in a downside scenario, say, you had that investment of $1 million in a $5 million post-money valuation company. If the company ultimately doesn't hit its goals and ends up selling for $3 million, they have to sell the whole company for $3 million. Now, the $3 million could either be split up if the preferred stock converted to common, that's for 20% of the company. And so $3 million, 20% of $3 million would be $600,000. Well, the investor's not going to like that because they didn't get their $1 million back. So what they're going to do is they're going to take their liquidation preference instead of converting to common. And so they're going to take the first $1 million to them, and then the rest goes to the common shareholders. The $2 million goes to the common shareholders pro rata. And as you can see, the investors at least get their money back, but they don't get any return. So that's how non-participating preferred would work. Alternatively, if non-participating preferred, if that company was sold for $100 million, right, then they would clearly convert to common, because 20% of $100 million is going to be $20 million, and they're going to get their $1 million back plus 19 additional million. And so that's what they would do. fully participating preferred stock is better for the investor. And so that's the next alternative here. And so that provision might say, first pay one time the original purchase price. So there's a liquidation preference, one times, plus accrued dividends, and thereafter pay the Series A preferred or thereafter the Series A preferred participates with the common stock pro rata on an as converted basis. So the preferred would first get its liquidation preference, and then it would convert to common and then get paid as a common shareholder as well. So, again, in my hypothetical there with the $1 million investor and the $5 million post-money valuation, they're going to get 20% of the shares on investment. And they're going to, if they sell the company for $3 million, they're going to get that first $1 million off the top, and then they're going to get 20% of the $2 million after that. And then again, in the $100 million sale, it's really not that big of a difference. They're going to get the $1 million up front and then 20% of $99 million moving forward. And so, it's really just as I mentioned, really more about downside protection than anything else. And then alternative 3 is just a cap on preferred stock. This is where you would, get paid one times your one-time liquidation preference, and then you would get paid up to a cap of a certain percentage, and then it all goes to the common. Again, under that scenario, they could convert to common at any time, but that would be, it would have to be a situation where they would make more on converting to common than getting their liquidation preference plus the cap. So anyway, this is how it might be set up in the term sheet. One of these 3 options is the most common, and so just be aware of what these look like. The amount of the liquidation preference, for example, 1 time, 2 times, 3 times, things like that, is very important as well. Like I said, typically it's 1 times liquidation preference now, and so if it's above that, then there'd have to be a very good reason to accept that as the entrepreneur. All right, pay to play provisions. These are also put in here in a lot of term sheets, and these is important in down round financing situations. So really, the thrust of what a pay to play provision is says that if the preferred shareholders don't invest in the next round in their pro rata amount, then they are automatically convert to common. So if I bought preferred shares in the Series Seed round, then there's a pay to play provision in the documents, and then they go to a Series A round and they raise more money, and I don't put in my pro rata investment, then I'm going to automatically convert my Series Seed shares, preferred shares, to common at that point, because I get punished for not investing in the follow-on round. So this is, a situation where, if you have to do a down round, again, if it's an up round and things are going well and the company's doing really well, most of the time people are going to want to invest, or the company may waive the pay to play provision rights there. However, or the company and the investor may waive those rights. But in a down round is where it becomes more important, because the company needs money, and so they're really looking for those investors to keep investing and funding the company. And if they don't, there's a penalty here, and so that's where it really becomes helpful. All right, so that's pay to play. Vesting. Okay, so vesting is another important item in the term sheet. Usually, stock of the founders the investors are going to want to create an incentive for the founders to keep working for the company, right? So they may have been issued themselves stock on the very outset of the company and not had it subject to vesting. Well, what the investors are worried about is they put in a bunch of money and then then those founders quit, and then now their investment is gone. And so what they want to do is provide some upside to the founders to continue to work for the company. And so they may either take the shares that have previously been vested and then make them subject to a repurchase right, or they may just issue additional shares on top of what they've already owned, but make those subject to vesting. And so either way, I would say there's also provisions in the term sheet about the option pool and employee pool and what that looks like, and whether those are always issued subject to vesting. And because usually that's pretty common for an investor to require that any shares issued under the pool are subject to vesting. And probably the most typical right now is 4-year vesting with a 1-year cliff. And that really just means that you don't invest anything until you're there for a year. So after you've been issued the shares, you have to stick around and stay employed or provide services to the company for a year, or you get nothing. After the year, then they usually start vesting either on a quarterly or monthly basis, or sometimes even on an annual basis after that. So, that's what the whole cliff thing is. Unvested shares, if unvested shares just go back to the pool. So if somebody doesn't vest in their shares, if they leave after 1 year, those, say they were issued 100 shares subject to vesting, those 100 shares just go back to the pool and are forfeited and are no longer issued and outstanding. So that's how vesting works, and it's usually addressed in the term sheet as well. All right, anti-dilution. Now this one I find is often, there's people describe this incorrectly. And so a lot of times investors come in and talk to a founder and say, hey, I want to have no dilution. And so there's a big, and they maybe reference an anti-dilution type provision. But there's a big difference between no dilution and what these anti-dilution provisions do. So, be very careful about this, because I've seen a lot of founders issue shares through documents that they've prepared themselves, and where they reference a percentage interest being issued to this investor as opposed to a certain number of shares. And the percentage interest is wrong, because if you raise more money, that percentage is going to change unless they invest their pro rata amount, and that shouldn't be an issue. Really, what anti-dilution does is prevent somebody from doing a down round. So, if I raise money, I'm a founder and I have a startup company, and I raise money from investors, that same post-money valuation of $5 million, and I take $1 million from investors. What they don't want is me to go and raise money now, 6 months later, at a $2 million valuation, because now those investors are paying a lot less price per share, and it's heavily diluting those old investors, right? And so that's what this is protecting. Not just if I go out and raise money at a $10 million valuation, this anti-dilution provision would never kick in, even though they are technically diluted by me taking on that round. It's not a severe dilution because the valuation is higher. And so, these are the three alternatives. Really, the third one is just that there is no price-based, there is no anti-dilution. The first one, which is, oftentimes there are term sheets without anti-dilution provisions. But the weighted average basically says that they're going to look at the size of the round. So, say we did that $1 million financing with a $5 million post-money valuation, and then later we did the company raised $100,000 at a $4 million valuation. Well, the anti-dilution is going to take into account the size of the down round issuance, not just that actual valuation. And so that's a better weighted average, is a better provision for the entrepreneur and the company. Full ratchet is pretty harsh. It just says, hey, if you raise any money at a lower valuation, even if it's $50, then everybody gets repriced at that round. So we would take those $1 million investors at the $5 million valuation. If you later raised $50 at a $4 million valuation, they would all those prior investors would get that same price, that same price of the $4 million valuation for all of their investment. So, and anyway, pretty harsh. Usually there's some carve outs for, if they waive their rights, or if there's, issuance under the pool and things like that don't count. But think about what carve outs you might want for a situation like that. All right, we're running close on time here. So dividends, really, I'm gonna skip this. This is dividends are not really, for early stage investors, are not really focused on dividends. That's really more on later stage companies. But here's a couple alternatives that may come up in a term sheet. Again, that's more a private equity style investment on later stage companies that are worried about dividends than early stage startup companies. Redemption rights. This is the last real provision that we're talking about here. This is where the investors have the right to force the company to purchase the shares at a certain price at a certain period of time. And this is really common for VCs because they have a life of their fund. And so they have to return money to their investors at a certain point when the fund is hit its life. And so they need to be able to cash out at some point. And this is really just a downside protection for the company that is only, it doesn't go out of business. It's kind of that single or double instead of the home run or a strikeout. And so this would, if the company doesn't have an IPO or doesn't get sold, then there's no liquidity to the investors. And so this is really a protection to them on that situation. So, they don't have a company that they own indefinitely with no ability to liquidate. And so those provisions are usually addressed in the term sheet as well. So that was a whirlwind tour here of financing term sheets, the economic terms. And so hopefully you got something from that. If you have any questions about that, I know we went through this very quickly. Please send me an email. Let me know if your company's raising money. Happy to talk to you about that. Or if you just have any questions. So that's it for today. Appreciate you guys taking the time, and stay tuned again for the next series coming up, which we're going to do Series Seed Financing Term Sheets Part 2 on the control terms. So anyway, thanks for joining. Appreciate it. Bye.